Alright guys, so the inflation crisis in the US isn't over yet. We are facing the perfect storm that's causing a big resurgence. Remember the Fed's mandate, Powell hasn't deviated from it at all. It's all about maximum employment and price stability. And the issue we have today isn't unemployment. The migrants are taking all the jobs and apparently it's great for the US economy. And that's why the payroll numbers are just so fantastic. So the big nightmare for the Fed is sticky inflation. It can't seem to go away, and the longer it lingers, the slimmer the odds of a rate cut. Powell has signaled to the world that he's delaying the rate cuts. Inflation has surprised to the upside and is going to keep rates steady for as long as needed. So if inflation continues to stay at 3.5% or heads higher towards 4%, we could see zero rate cuts this year. Not two cuts, not one cut, but no cuts at all. Now the Fed is surprised, but we all knew inflation was going to rebound. You combine endless fiscal spending with big supply shocks in Russia and the Middle East, we have a recipe for disaster. And it's very important we listen to Powell's language because it reveals a lot about his intentions. He's extremely data dependent and the inflation numbers are simply horrible. The recent data have clearly not given us greater confidence and it instead indicates that it's likely to take longer than expected to achieve that confidence. In other words, the Fed's inflation fight has failed. Rates are not restrictive enough. Given the strength of the labor market, it is appropriate to allow restrictive policy further time to work. So the economy now is robust as well. Jobs are being added, and this allows rates to stay higher for longer. The problem with zero rate cuts is the risk it will impose on the economy as well as the markets. It's just one big house of cards waiting for an accident to happen. Now, there are some people out there saying that higher rates are actually good for the economy. Because rates are higher, Americans holding bonds have a bigger stream of income. There's more money to spend, and that's driving growth. And on the surface, the numbers seem to agree with the claims. It looks like a very fantastic story. Before the hike started, GDP growth was only 2.5%. After the hikes, it's now 4.2%. Corporate profits are up by $400 billion as well. And let's not forget the S&P 500. The stock market has broken past 5,000 points. But this line of thinking is very dangerous. If higher rates are great for the economy, Powell should hike to 10% tomorrow. He should hike to 10% today, but he won't. The Fed simply can't. The GDP numbers are being powered entirely by deficit spending. The US budget deficit was 6.3% of GDP last year, and the borrowing is only going to grow in 2024. However, if rates stay persistently high, the US government will create a runaway debt crisis. Congress will have to decide now. Do you keep propping up the US economy in the short term or do you allow the crash to happen? And either scenario will be painful. We are at a tipping point where inflation could force the Federal Reserve to stay higher for longer, and it could cause something in the system to break. The market is already starting to freak out. Just look at the stock market. The S&P is down to nearly 5,000 points. It's pricing near zero cuts in June, one cut by September, and just under two cuts by December. And by the end of the year, we could still be at 5% Fed funds. The longer the cuts get delayed, the more pressure gets built up in the economy. At high interest rates, you would think that the market would pounce on US bonds. After all, you'll be getting a real yield today. Now, if rates are near 5% and inflation is only at 3.5%, you want to buy a ton of bonds to lock in your returns today, but that isn't happening at all. In fact, investors are avoiding US debt. They see the big inflation threat and they know yields will stay higher. They'll hit higher if inflation continues staying hot. People aren't buying bonds because bonds are still very dangerous. The highest treasury yields of the year failed to tempt buyers to auction. Even after yields surged over 4.5% on the long end, there weren't many buyers, and this is a very big problem. Remember how bonds work. If yields continue to rise, the value of the bond will continue to fall. There's not much point if you lock in a 1% real yield when the value of your bond drops by 2% or even 3%. It is still a net loss and investors aren't that stupid. Within a matter of days, the 10-year yield spiked from 4.35% to over 4.6%. And that's an insane move of 200 basis points that's wiping out bondholders. And it's very important we look at the environment the US economy is in. Fiscal spending is out of control. So demand is still flowing into sectors of the economy like the military industrial complex, the MIC. and that pushes headline GDP up and make things seem very, very rosy. Then we have two endless wars that are putting pressure on oil prices. Brent has risen sharply to over $90 a few days ago. If we treated a little, but the damage has been done. We are starting to see inflation trickle across the economy and push prices up. And because of this, the Fed can't afford to cut. But as Yellen continues issuing bonds, this will cause yields to stay high on the long end. The recent 20-year bond auction results are out, and it shows the second highest yield since 2020. It's on its way back to 5% or more. So yields across the curve are moving upwards. The short end is staying high because the Fed isn't cutting, and the long end of the curve is heading up because Congress keeps spending more and more money. The failed debt auction is a sign that inflation surge isn't over yet. Investors realize that the yields could rise further and their losses could keep piling up. And this selling, this non buying, ironically pushes the cost of borrowing even higher for the US government. Now, banks on Wall Street are also in serious panic. They believe the Fed could raise rates even higher in 2025, that the inflation disaster could get much worse. If expansion remains resilient and inflation gets stuck at 2.5%, there's a risk of the Fed raising rates again by early next year, and that could bring us up to 6.5% Fed funds. So, more hikes is a risk that UBS is pricing in. And if that happens, the stock market could fall easily by 10 to 15% or maybe even 20% or more. We aren't out of the woods just yet. Even at 5.5%, many things could break in the US economy and the world at large. When the Fed refuses to cut rates, it affects the global financial system. But let's talk about the US first, because that's the epicenter of this crisis. The biggest risk to the system is once again commercial real estate. US regional banks are starting to book more CRE losses on their books. They are starting to squirrel away more money to cover their potential losses. The banks are also moving to sell away their property loans to raise cash. And this has the risk of reigniting another liquidity squeeze throughout the financial system. If banks need more reserves, that leads to higher borrowing costs for everyone out there. Taking a loan will cost more because Wall Street is afraid of potential defaults. The prime rate in the US is already at 8.5%. And this is from Bank of America and is similar across every other bank, including JP Morgan. And that is the rate that banks are lending to their best customers, their preferred customers. And the longer rate cuts get delayed, this number will continue to remain at 8.5% or even go higher if a CRE collapse happens. The problem with the banking system today is their exposure to commercial real estate and how their heads are all in the sand. The banks have been pushing their maturing loans to the following year. Goldman found that nearly 50% of 2023 CRE maturities were pushed to this year. The bars above the zero line shows the amount of loans that were pushed from last year to this year. The bars below show the loans that were paid off, and it's obvious more loans are being pushed to the future than the debts being paid on time. Wall Street is delaying the implosion because they believe the Fed will cut rates, and this will allow CRE owners to refinance at a lower rate, and that in turn helps to stabilize the price collapse. But as we all know, that isn't going to happen. It's very unlikely. Powell might not even cut once this year. And according to the US Mortgage Bankers Association, almost $1 trillion worth of CRE debt will need to be settled this year alone. The US economy is about to feel the impact of this loan tsunami. Landlords either have to pay back the loan in full or refinance them. And let's be realistic here, paying back in full is nearly impossible. And a big shout out to our sponsor today, IPM Bullion. When it comes to buying precious metals, my number one dealer in Singapore is IPM. Now, I've been stacking gold for over a decade and I've learned two things when buying. You want to buy authentic gold bullion and you want to buy at the lowest premium possible to stretch your dollars further. And I'm glad to say that I found both of these at IPM Bullion. There's lots of uncertainty in the world today. We have geopolitical chaos and the value of currencies getting debased. And that's why I consistently buy some gold every single month to preserve my buying power. IPM Bullion is a leading retailer in Singapore and they specialize in physical gold, silver, and platinum. They are my one-stop shop when it comes to buying bullion. Their prices are sharp and they have the best brands on sale, and best of all, I can test the gold on the spot. So if you're looking to make your first gold purchase, IPM is the best place to start. Whether it's 1 ounce or 1 kilo, IPM is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount for your first purchase with the discount code SeanFu. Start your goal stacking journey today. Selling your building now will get you maybe 60 to 70 cents on the dollar at best. You're left with a gigantic hole to fill. Refinancing is also unthinkable. You'll be borrowing at much higher rates today, maybe 2 times or even 3 times higher. And this is the crisis Wall Street is facing. They need the Fed to swoop in to save them to desperately cut, or CRE prices could literally implode. Landlords could simply default on their loans and throw the keys back to the banks, then the real fireworks will begin. The banks are still playing a game of pretend and extend. They aren't marking their books to reflect the losses just yet. And that's why everything still looks placid and calm, but they can't hide forever. There's a total of $320 billion of CRE assets in big trouble. The majority of them are facing delinquencies and forbearances. Landlords are facing big problems trying to bring revenue in, but look at the portion in black. Over 25%, they are in extreme distress, and these are assets on the brink of bankruptcy and default. The house of cards is starting to shake and the rates need to come down soon. And this is the tail risk mainstream media is trying to downplay, a risk that Wall Street is desperately trying to sweep under the rug. It has the potential to cause a big credit crunch in the US. Now, higher rates from the Fed don't just affect the US alone, it affects the entire world. And this is where we must talk about the Japanese yen, because this major currency is still falling today thanks to Fed policy. The yen is expected to fall by another 10% versus the dollar. The currency might be about to hit pre-1990 levels. We could be moving closer towards 170 to the USD. And obviously, this is bad news for the fourth biggest economy in the world. If the yen keeps weakening, imports to Japan are gonna fall. Local inflation is gonna rise further from this devaluation. And it's a big blow for consumers in Japan. Inflation is gonna stay uncomfortably high. It's gonna hammer domestic demand for foreign goods. We are seeing a very interesting situation happen in Japan. As predicted, their imports in March are down by 4.9%. The imports of fuel declined by a lot. Coal imports fell by 35% and LNG dropped by almost 10% as well. The imports into Japan are decreasing, which isn't good. A growing economy should be consuming more and exporting more at the same time. The only reason why exports have grown by 7.3% is because of the collapsing yen. But in terms of volume, Japan's shipments actually fell by 2.1% last month. This highlights the underlying weakness in Japanese manufacturing. The weakening yen is still a net negative for Tokyo. However, Japan is trapped. We have said quite a few times that nothing can be done to reverse this trend for the long term. Not even currency intervention can work. Japan can sell all the dollars they want to buy back the yen, but it's simply a stopgap measure. For many weeks, the BOJ threatened to dump dollars to defend the yen, but the finance minister has taken a step back. Even though the yen has crashed to a 30-year low, he's hesitating. It's now over 154 to the dollar, and it's simple to understand why. The fate of the yen is tied to interest rates set by the Federal Reserve. The higher the yield differential, which is the difference between US and Japanese bonds, the greater the collapse will be. And this chart confirms what we have been saying all along. The dollar yen exchange rate is in black, while the yield differential is in red. As the Fed keeps interest rates higher, this causes the dollar to appreciate against the yen. In other words, the yen is getting devalued further as US yields stay higher for longer. Any currency intervention will be short-lived. It could last for a week or maybe a few months, maybe even a year, but the yen will drop against the dollar again. You can't fight against gravity forever. So this is going to hurt the Japanese economy and their overall consumption. Not good for the global demand picture. Now, I'm not saying that it's all doom and gloom for Japan. Tourism is up by almost 70% in March, hitting over 3 million visitors. The cherry blossom season is seeing a record number of tourists. People are flocking to Japan because of the collapsing yen. So if you want to take a holiday now is the perfect time to visit Japan. Everything is cheaper and you'll have a blast, you'll have a hell of a time. But the overall macro picture is extremely weak. Imports across the world, they're dropping like flies. US demand is down, Chinese demand is down, and the Japanese demand has crashed. There's a limit to how long the world can really withstand high interest rates from the Federal Reserve. But let's expand a little more on Japan and why they aren't intervening yet, and it all has to do with Chinese exports. We know China manufactures cheap goods. they are a direct competitor to Japan. Because of this, Japan has to ensure the yen continues to stay low versus the Chinese yuan, and that's the only way left to compete. The yen has been crashing against the yuan. It's down by almost 7% since the start of the year. Horrible for people in Japan, but great for exporters in the country. It allows them to grow their exports despite Chinese competition. And this is another reason why the BOJ is hesitant to save the yen. Trying to save it could crash Japanese exports. If the yen appreciates, Chinese products will become cheaper and grab market share. And that's something that Kishida can't afford to do now. Japan's crisis is a byproduct of interest rates back in the US, and that is happening across the world. Many countries today face a currency crisis. Fed policy in the US is pushing the world off a cliff. And the only way for rates to come down is for inflation to drop. And to do that, you need to stop all the supply shocks, which means ending both wars at once. But let me know what you think. Will the Fed cut rates this year, or will Powell do the unthinkable and hike even higher? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.